The Federal Treasurer Josh Frydenberg looks to be preparing the market for a regulatory clampdown on home prices. The IMF and major banks have flagged the need for some intervention after CoreLogic showed national home prices rose more than 18% in the year to August. The Treasurer looks set to give regulators the green light soon, saying carefully targeted and timely adjustments are sometimes necessary and there are a range of tools available to deliver this outcome. Low rates have seen a surge in new loans from both investors and owner-occupiers, with commitments doubling in the past year. But RBA Governor Philip Lowe has said raising rates isn't the fix. Instead, targeting the debt-to-income ratio seems the likely strategy, as borrowers are taking on more and more debt. Recent data showing a big jump in loans at 6 times the borrower's income. Any formal action, though, could still be some weeks or months away. I spoke with Tillien about what that action could be. Tillien, welcome to the program.
Good evening, thank you.
What's your view on the Australian housing market? Are warning lights flashing?
Not universally. Obviously, prices are very high now relative to incomes at record highs in all the major capital cities. But household debt is not at record highs. The main reason is that households during the pandemic used their very high savings to pay down debt, and credit growth is also still relatively muted. So at this stage, it's not flashing red. Also, the lending standards overall are not flashing red yet. The usual suspects, for example, interest-only lending, loan-to-value ratios, those are all signaling relatively sound lending standards. That said, the early indications are that over the next few months, the housing market will start to flash red. But one reason is that we've had this surge in housing finance commitments, which suggests that credit growth will continue to accelerate. Also, once your economy reopens, households will probably stop repaying such large amounts of loans as they will spend money elsewhere. So all this suggests that household debt will start to accelerate relative to income. So at some stage, additional restrictions will probably be required.
And in the June quarter, we did see that debt-to-income ratio pick up fairly substantially, with more people borrowing 6 times their income. Is that starting to concern you?
Yes, that's one of the areas. So even if loan-to-value ratios remain healthy, if house prices continue to rise, then very sharply, then people will simply have to borrow more to afford any given house, and that means at some point their debt situation will become stretched, even if on paper the lending restrictions still look sound. And that is probably also the area that is starting to concern the regulators and is the one where I think they're most likely to impose restrictions on.
Is it looking more likely that regulators are going to move to cool home prices in this country?
I think we've gotten a bit mixed signals. I mean, the RBA governor has said that they're monitoring standards closely, but he also said that soaring house prices themselves are not something for monetary policy to address. So I would think at the margin, yes, but it's probably not imminent yet. Also, the other factor to consider is that obviously the economy is still in lockdown, and at this stage imposing additional restrictions is not helpful. I mean, the RBA has argued that soaring house prices are one of the areas that help prevent a big downturn in the economy. So until the economy is out of the woods and the lockdowns have ended, I would think that regulators will stay on the sidelines.
Well, if macroprudential tools are implemented to cool home prices in Australia, when do you think they would be implemented?
Well, our base case is that it will be implemented towards the middle of next year. But I guess if house prices keep soaring rapidly and if credit growth accelerates fast, then the risk is that it could happen earlier. So perhaps in the first quarter of next year already.
And what form do you think they will take? We mentioned the debt-to-income ratio. What do you think regulators will target?
Well, the debt-to-income ratio is I think, the most likely factor. The other is that with interest rates hikes starting to come on the agenda, regulators might also want to ensure that households have some buffer to afford their mortgages when interest rates actually pick up. So So it's possible that the regulators will also change the serviceability buffer on mortgages. It's currently quite high, 2.5%, but they might want to make sure that it's sufficient to prevent households or for households to keep affording the mortgages, even if interest rates rise further.
Well, CBA lifted its serviceability buffer last week or so. What kind of level do you think banks would be looking at?
Well, the mortgage buffer that CBA currently has is still quite low. If you think that the discounted variable rate of banks is currently around 3.5%. So if you add the current 2.5% buffer to that, you get something like 6%. So I think, before the pandemic, we had a serviceability buffer of 7%. So I think that something like 6 to 7% would probably be a cautious level. So there's still some way to go to get there.
Just for some context, when it comes to the debt to income ratio, what's the average level? When we're looking at debt to income ratios above 6, that's obviously concerning. What's acceptable?
Well, I'm not quite sure what the average is, but we know that about 40% of all loans have debt to income ratios between 4 and 6. And I think above 6 is also something that the RBNZ has looked at as something being a bit too high. So I guess it boils down to what share of income eventually households can afford, and that ratio is at the moment already. It has fallen a lot during the pandemic, but it was close to record highs just before. So I guess this is the factor that the RBA wants to look at, that the overall interest servicing burden on households doesn't become too high.
How different is it this time to, say, 2014-15, when we last saw intervention from APRA?
Well, I think the key, there are a few differences. One is obviously we're just at the start of a housing boom. Back then it was a pretty long housing boom where house prices rose very sharply for a very long time. And also back then we had a broad-based deterioration in lending standards, with interest-only loans accounting for nearly half of all loans. Also, the investors were much more active in the market. So clearly back then we had a much broader deterioration in the fundamental health of the lending, whereas now I think there are just pockets of weakness emerging. So we're at the early stages of you could say a bubble, if you want.
And homes, particularly houses, are now out of reach for many working Australians if they're trying to save a deposit. How can regulators balance, say, restrictions without hurting potential first home buyers?
Well, it's tricky. Obviously, you want to, on the one hand, ensure the health of the financial system, but as you say, you don't want to make it too difficult for first-time home buyers to enter the market. I guess the answer is probably some targeted subsidies, some housing grants. That's been used in Australia before. I think that's probably the answer to address the imbalance. Also with the red hot housing market, property sales close to record highs, stamp duty revenue should now be rising. So I think the state governments should have some scope to pass some of their revenue in the form of subsidies to first-time home buyers.
The RBA is committed to keeping interest rates where they are now until 2024. You think they'll have to move early 2023? Why?
Well, we're now seeing broad-based upward pressure on inflation stemming from soaring energy prices, soaring food prices. So all this suggests that headline inflation will remain above the RBA's target at least until the middle of next year. And there are already signs that this is boosting the inflation expectations of union officials, for example. So we're probably going to see a stronger push by employees to demand higher pay rises to compensate for those strong price rises. And that in turn, coupled with the increasingly tight labor market, that suggests to us that wage growth will pick up more rapidly than the RBA is anticipating. And given that the RBA has flagged wage growth as a key factor for meeting its inflation target, that in turn should then convince it that interest rate hikes are required by early 2023.
But will the RBA be constrained by how far they can push rates up, given this heavy household debt burden we've been talking about?
Yes, to some extent, yes. Obviously, as I mentioned, the household debt to income ratio is close to record highs. And all the indications are that it will keep rising reasonably rapidly over the next few months. So if you add in rising interest rates, that means that households' debt burden or the debt servicing cost will increase quite substantially. So if the RBA were to hike rates by, let's say, 200 basis points, as they have done on average in previous tightening cycles, we estimate that about 3% of household income would have to be devoted to additional to debt servicing, and that's if you assume that debt ratios are stable. Now, if the debt ratio rises, or if the household debt to income ratio rises by around 10 percentage points, then you would look at something like 4 percentage points. So 4 percentage points of income devoted to debt servicing, that's quite a substantial share. And it means that households have less income to spend on other goods and services, which in turn means quite a big drag on activity. So the RBA will have to be cautious in lifting interest rates. And we only think rates will surpass 1% by 2024.
Marcel, Tillien, thank you so much for your time.
Thanks.